Apoorva Pandhi has been in AI since 2014, long before it was a rage. As a managing director at Zetta Venture Partners, a San Francisco based fund betting on AI native founders, he is watching a platform shift bigger than internet, cloud, or mobile. But he is also seeing something else: blind experimentation giving way to brutal ROI scrutiny, companies raising at absurd valuations before proving anything, and a failure rate spurred between seed and Series A. In this episode of ET in the Valley, I talk to Apoorva to figure out what's really durable in AI. It's Wednesday, the 14th of January. I'm Swathi Moorthy. This is the Morning Brief. Hi Apoorva, thanks a lot for joining us today in San Francisco. No conversation start or end without AI. More so in the AI epicenter where we are sitting right now. From your vantage point, what is real in AI and what is just hype?
I think it's once in a lifetime where you actually see like platform shift happen in the market. Last few platform shifts have been internet, cloud, mobile. This is like even bigger in many ways because we feel that there are aspects of different platform shifts that we've seen before that AI incorporates, like the substrate LLMs. You could kind of compare it to TCP/IP from the internet days. If you think of kind of the market structure, although it's like more evolving than the cloud market structure, although infrastructure in cloud was very much fixed in terms of like hard to move from one cloud to the other. It's easier to move from one LLM to the other in the market today. And there are elements of mobile as well, because I think one of the reasons that you're seeing like these massive adoptions of applications in the market is because of a UI shift. Like when we saw mobile, the reason mobile grew faster than cloud was because mobile had a UI shift. You could actually see how the interface was different than the machine interface. Now it's very different because it's a conversational interface. And it's made it easier for people, whether it's technical or non-technical people, to kind of retrieve knowledge, create things, take actions on their behalf using a conversational interface. And that's what's leading to this massive adoption. So what we're seeing in the market is the technology is still evolving. It's achieved a lot, but it's still early in its days. Like even with what we have today, we are seeing like a lot of things that couldn't be built before to kind of augment or replace human workflows, which SaaS could not do before, because SaaS was meant for like a one-size-fits-all use case approach, versus now you can kind of really customize, personalize applications based on like what individuals need.
Does this make investing harder for you? How are you differentiating signals from the noise, and how has that changed your investment thesis?
This is also once in a lifetime thing where everyone is learning at the same time. I think historically, the way we used to think about investing is research used to happen. It used to get published. A lot of people, whether in web scale companies or academic researchers, used to pick up that research and actually experiment and create products, or at least prove out that research. Right now, a lot of research is not being published. It is actually a part of like some of these big AI labs. And so one of the big questions that's every investor has or every operator has is like, what's next? And you're trying to stay on top of like, what would be the next big model improvement? Because it doesn't just have an implication on like technology landscape. It has an implication on like the application landscape as well. Because like if it's a step change improvement in the models, then it could kind of wipe out a lot of applications. And it's also this big question of like whether the step change improvement will happen based on the current architecture, or would that require a different architecture itself? Because the onus is on like both the investors and the early founders, because you have to kind of, as an investor, stay on top of kind of what's going to happen next. You're assessing founders not just based on like their ability to build, their ability to like think through go-to-market and product, but also their ability to kind of stay on top of these trends and how to benefit from these trends. So I think that's what's made it harder. And then there are like UI revolution. You're seeing consumers adopt it much more compared to before.
So, Apoorva, in a market that is swinging from blind experimentation to ROI realizations, what is one metric that you look at that tells you this company is real and not just riding the hype?
I've been in the AI space since 2014, 2015. I remember at that time, if you were talking about AI to anyone outside of data scientists or ML platform folks, or people who were adopting computer vision or deep learning, people didn't want to talk about it because they were like, we don't want to think about buying AI or ML. Tell us, like, what product are you bringing to us to solve our pain point? What software budget does it fits in? What is it replacing? What is the net new market that you're starting? I think the market, at least in 2023 or 2024, moved to the other extreme where like we are kind of experimenting with everything AI because it was unknown what the possibilities of AI were. It is still unknown, but I think as the market is maturing, people are realizing where it is feasible, where it's hallucinating. And so they are slowly realizing like what they need to incorporate internally, whether you are like technical or non-technical. And so the consumer side has changed as well. Like people are buying things across the board. And the adoption for some of the companies is just growing like a hockey stick. So as an investor, you're trying to figure out is which of these categories has a big enough market that will actually grow. Is a lot of that growth sustainable? So far, the AI markets have been fairly giving to investors because if something is working, it continues to get marked up. But that is not always going to be the case. And if there's a step change in the models, then that's definitely not going to be the case. So I think those are all the challenges that investors are kind of thinking about.
Every time OpenAI or an Anthropic comes up with a new feature, it decimates a set of startups. The AI startup graveyard is already a thing and happening much faster than before. How do you underwrite such risk in this market?
Well, I think to answer your question, I don't know if we'll see them go to the grave early just because they've raised so much. They might be zombies for the longest time. But you might just see a lot of companies that haven't been able to raise that much and are talking about an AI story that might not be a true AI story fail quickly. I think the failure rate is highest between seed and A right now, just because the companies look very similar between pre-seed, seed, and Series A. And if you haven't shown clear signals, not just in terms of revenue, but adoption, ability to build product, ability to kind of delight customers between seed and Series A, it's really hard to raise your next round. From Series A to Series B or Series C, I'd argue that there is momentum. But between seed and A is where we're seeing like the most failure rate happen. So the way we think about investing is like, firstly, we are seed investors. The seed stage also means that we are taking bets on pain points in the market and teams. They may or may not have products yet. So which makes it even more riskier because the loss ratio at that time is higher. But I think there are some core beliefs and first principles that are going in that investing. I think one of them is which layers of the stack do we need to focus on as an early investor where they are asset light. They might not take as much money over the lifetime, and so that we still have meaningful ownership by the time we exit. And those that will actually not be at odds with the foundation model stack, but will actually benefit from like improving models, because we believe that like this new platform shift will actually change the way the market operates. And today we have two big platforms in the market, Snowflake and Databricks. What are the other things that need to be built out that could become platforms in the future? Some of them might still be bought over by Databricks and Snowflake, but then we need to kind of invest in things early on that will actually become the next platform for the AI first world. The other is the AI tools and platforms layer, which today in the market has become very noisy, and it's very different from how it played out in the ML world. Because in the ML world, since the innovation was happening over a longer phase, we saw that like a lot of applications scaled. If you think of Meta and Google and others, they'd built a lot of good consumer applications. And within those companies, we had a lot of infrastructure builders who pressure tested that infrastructure for those ML use cases internally. And once those infrastructures were really pressure tested, that's when they became mainstream or commercial. Right now, the market is flipped. Like infrastructure has kind of been built before applications have gone mainstream. Like what was built like in 2023 in terms of orchestration, there were companies like LangChain or AI Assurance, and all of them have taken like a certain architectural bet that this is where the market will be headed. But that architectural bet is continuously evolving. So what will end up happening is once these applications go in production, you'll realize what architectures really matter.
AI valuations are so inflated right now. Companies are raising money at insane valuations. In such a scenario, are you deliberately choosing to invest in companies that fall in your ambit, or
That's one of the reasons we are focusing on seed. Because when you go as upstream as possible to find practitioners and researchers and invest in them pre-product, you are also to a certain extent ensuring some price discipline. Now, the price discipline in today's market is different from what it used to be.
Yeah, Apoorva, can you give me the numbers? What are they like?
A reasonable seed deal is happening, or pre-seed deal is happening between 15 to 25 post. That is reasonable.
That's valuation, is it?
That's valuation. But many times when repeat founders are raising capital, because valuation is not just a function of what you want as a valuation, it's a function of how much you're raising. So if you're raising like around 8 to 10 in the seed round to start off with, then your valuation ends up being north of 35 or 40 post at seed stage. And this is kind of based on what you're raising, but there are certain people who are also raising at 100 post or a 200 post and calling it a seed round. I think in those cases, there is a possibility of losing money just because you're not following that price discipline. And so you have to be very conscious as an investor, like to what extent would you have those kind of portfolio companies as a mix in your portfolio? Like, this is my first check. And they need to prove out these milestones to get to a certain valuation in the next round. And if they are way ahead of their valuation given the stage, then you have to take a call on whether you're doubling down at that company in the next round or not. And it also depends on the assessment that you have of that company and the market and where the market is. So I'd say that if you are raising in the 15 to 25 to even like 40 million range, the market is acquisitive right now. And for the right team and the right product, even if it hasn't found product market fit, you might find the right acquisitions in the market, or you might find the right acquirer in the market. But if it is raising beyond that, getting acquired for like north of 200 is not straightforward. You need to have built some meaningful momentum with customers before you can assume to get acquired for like north of 200. I think any acquisitions that have happened north of 500, which don't have the traction that I'm talking about, has been just because like the founder of the acquirers really wanted to acquire that team. And you can't take that bet all the time.
If you look at the Valley, there are so many Indian founders starting up. Are you seeing a visible surge of Indian founders building AI companies in the Valley right now?
This is the trend that actually we've been seeing not just today. I think we've been seeing this for the last so many years.
In a way, has it accelerated?
Lot accelerated. Earlier, we used to see enterprise and B2B companies started by people who were either they were serial founders and repeat founders, or they were like practitioners for many years. And then they thought of like, this is a pain point that I've been working on. I've pressure tested it internally. Let me just build something externally. Now it's happening much more often, like, and it's happening way sooner. I worked at like two of these AI companies that have scaled or are scaling. I've seen the scale happen not over a long period of time. I worked at Perplexity, for example. I've seen that company scale like within a few months. And I've seen that level of scale so quickly in my life that I'm like excited to start my own company. So we're seeing that happen more often now, earlier, and not just happen from like people who are at companies, literally like fresh grads. And the reason it's happening with fresh grads is because unlike before, the product development life cycles have shrunk. You don't have to build your own model to be able to create a personalized experience for end users in a bigger company. You can literally take APIs and build your product, ship it out, see adoption, and start to feel like you can build a company. It may or may not take off, but like you're a student. In fact, the other day I was talking to a student who's, I think, in the second year and already has like a couple of $1 million of revenue for her company. And like it is unprecedented. And I think as product development life cycles are shrinking, it shows that hustle, go to market, ability to kind of like really be creative with how you get the product in the hands of the users has become immensely important. Either you're on one hand just a research company, or you're building an application and you could literally build that very quickly. Now, the question is, every enterprise application going to be built that easily? No, because some of them are going to be built for engineering, for IT, that will have huge aspects of reliability and hallucination that you can't tolerate. And you want that to be hardened, and you require distributed systems thinking. So not every application can be just built very quickly. But some of those applications, like which are being sold to sales, marketing, product, can be built very quickly, and people can start adopting it like just as prosumers and then take it to work. And I think for that reason, we are seeing like a lot of younger people start companies.
Would you say that the average age of people who are starting up is coming down?
It's coming way down. And like look at like even companies like give examples of like Mercor or Cursor, for example, where people are way younger. I think the Mercor founders are in their early 20s.
Are we seeing a fundamental shift where researchers, not just techies, who are now becoming most powerful startup creators in AI?
Earlier researchers used to be very academic and they used to write papers. Now a lot of those researchers are like, we need to build as well. And there are different kinds of researchers, right? One is like that are very much focused on certain domains. For example, researchers in biology or researchers in material sciences. And they're like, we need to kind of figure out the cross-disciplinary parts of research, because one part of it is understanding the domain. The other part of it is understanding machine learning or AI and what's happening in that space. And now they are like, we should be kind of not just building the backbone of this application, but also building the full stack application itself. Take material sciences or biochemistry itself. Now they are trying to figure out like, what does it mean? Are these foundation models applicable to our domains as well? If not, then let's build our own from scratch. Like, what could it be applicable for? Whether it's antibody discovery or whether it's like cancer research and so on. And some of them are like vibe researchers, like students who are like writing papers for NeurIPS and so on. So that is more on the research side. And we've been actively exploring the research side as well. We've seen like infrastructure companies come out of research where you're trying to figure out how to maximize the benefits of all the cloud providers in this space. Like, how do you kind of think about LLMs and how to kind of improve LLMs more on the post-training side? But then we're also seeing like researchers in biochemistry, we're seeing researchers in material science. And that's another area that was earlier slower to founding companies. And now it's become a vibrant ground to kind of start companies as well.
Have you seen any of those? What are some of the interesting companies, which has researchers as co-founders? Can you name some of them?
So I think in our portfolio on the domain side, we've backed companies like Nabla Bio, which is in antibody design. Both the researchers came from George Church's lab at Harvard University, which is known for CRISPR technologies. Then there is a company called Noetic, which is in cancer research, which is basically building a foundation model from scratch again. And the founder was one of the execs at Recursion, which is a public company, again, a big biotech public company. We have Periodic Labs, which is Liam Ferris's company. And then I think any of the areas on the infrastructure layer and on the data layer where we feel that there are certain aspects that require research. Like, for example, backed a company like called Guardrails AI, which is doing both guardrails for your models as well as they've built a product called Snow Globe, which does simulated personas for application testing. The founder comes from self-driving background, and that was the kind of research that happened in self-driving back in the day. So that's more on the infra layer, for example. So there are examples across the stack.
Larger funds are now coming for early stage AI companies, which has not been the case before. As an early stage investor and as a smaller fund, are you at a disadvantage because mega funds are moving in into seed with far bigger checkbooks?
Definitely, because they're coming early, they are driving up prices. So on one hand, yes. On the other hand, we have to invest in the 25 best companies that we find over the lifetime of the fund. So what that means is like one is dabbling in domains which not every fund will get. Things like life sciences, material sciences, etc. And in areas that we do well or extremely well, which is data infrastructure or like many areas of AI infrastructure as well. And now we've started to do vertical apps, which is like not that every fund does. And many funds look at vertical apps when they have meaningful scale. We are doing those very early, which is risky. But the idea is to like, if you are going really early, which is the business model of a big fund, right? Where you have to invest in momentum and that is your focus area. And you still do seeds for optionality, but at the same time, your bread and butter is growth. So if you're doing seeds for optionality, then you're not like as focused on going upstream and finding people before they start companies. So it's about figuring out what your core focus areas are within the stack, going really upstream to build relationships with people who could start companies, ideally lead their pre-seeds, and these funds can come and lead their seeds. But even if they end up having a round which is a seed early on, and that's why, like, given the size of the fund, the core check is anywhere from like 5% to 15%. So we can play well with any big fund that wants to co-invest. But since you get to know the founders over a long period of time, you get the right to be in the round. But yeah, you're right. The idea is to like be early and do a round before anyone drives up prices.
As a VC, if I were to ask you, as someone investing in AI and based in San Francisco, what are some of the best and the worst thing that has happened in the last couple of years?
I think the best thing that's happened is that investors were never as close to research as they are today. Because it used to be always that like we are reading about research way later after it's happened, but the core building blocks have been figured out. We are investing in abstractions. Now it's like you're investing in core fundamental technologies that will actually drive the future. And a lot of them haven't even been figured out yet. Like take physical AI, for example, hasn't even been figured out yet. So I feel very excited about the fact that we are part of that journey in the last 2-3 years. I think a lot of investors have now very excited to read papers, not just like investors, but like even non-technical folks who are now like coding using like cursors of the world. It's pretty exciting to see that. You've kind of up-leveled a lot of people. The worst thing, I think, just thinking that these models are superpowers before like they actually do. So there are two kinds of things that the models are expected to do, right? One is retrieving knowledge. The other is to take action. I think retrieving knowledge makes sense because they are autoregressive models. They can actually figure out the next token in the sequence. They are not built to take action, right? And that's what we are trying to do to build agents on top of these models. Requires a lot of work today. And then there's still a lot of hallucination in these models. Now, obviously, there's a step change in the models themselves in terms of how they behave, how they become objective driven. Then these problems will be solved, but they're not solved yet. And so when people say like your work will be taken over by these models, I think it's a misnomer. It's not happening today. Sure, they can be at best like co-pilots and they can at best be agencies. When I talk about agency, it's like you're anyways outsourcing some work. Those companies will have higher margins. But if you assume that I can expect an agent to kind of be my paralegal today, not that will happen. I'm not saying that won't happen. Unless things change meaningfully in terms of architectures, in terms of reasoning capabilities, it's not there yet. I think that there's still like simple prompts.
Okay. But that's not really the worst thing, right, Apoorva? In a way, that could be progress.
No, the worst thing is related to that, right? They are being valued like that. They are raising and being valued, and the narrative is that. Because I feel like there is always a journey to evolution of a technology. If you expect too much early on, and if you reward it early on, the downfall will be more compared to like if you are seeing the progress and reward it based on what it can actually do. So I think that's what I worry about.
Interesting take, Apoorva. Thanks a lot for joining us and thank you for your time.
Yeah.
The AI rush has made everyone a researcher, a coder, a founder. But Apoorva's warning is clear. Models that can't yet take action are already being valued like they can. The gap between narrative and capability is where the fortunes will be made and lost. That's it for today. This episode was produced by Vinay Joshi, sound designed by Indranil Bhattacharjee. We hope you like this episode. Keep listening.